Fancy meeting you here.
Okay, I emailed him. I emailed him we're gonna be on here. I wasn't expecting you to work Labor Day too.
Of course. Of course. Work every day, Kent.
So you're definitely down for this murder mystery dinner, right?
Of course. I can't wait. I've never done something like that, so it sounds really, really exciting.
Hi, everybody.
Give me 1 second. All right, I'm back.
I'm just gonna text Alvin really quick. Make sure he's coming on.
What's up, y'all? Hey, Kent, Peggy, I just put our chat in. I put this link to this Zoom in the chat on Clubhouse, so we may have quite a few people watching us build this Proforma.
Okay.
All right. What up, y'all? Darryl, good to see you, man. We need to get together on that deal down in Sugarland. So let's talk about it after this.
Sure, my man. I'll connect with you this week. I'll get with you for sure.
Sounds good.
All right, brother.
Okay. Oh, let's see. Kent, did you see my email about the so guys, let me just start this off by saying thank y'all for joining us. We're gonna put this on YouTube also. And so in this segment or in this episode or in this recording, we're going to put together a pro forma for a 256 unit apartment complex in Arlington, Texas. Our team, Kent Peggy Lawless, and Ariel, she may join, she may not. We have a consulting company called Springboard RA. And at Springboard, what we do is we partner with other people that want to have an apartment complex. We do all the consulting, taking the property from non-entitled for multifamily all the way through the process of giving you some keys if that's what you want. And so on this particular transaction, we have a church in Arlington, Texas that has 13.66 acres. And on that 13.6 acres, I'm going to show you a couple of things before we get started on that. And I'll show you what the initial thought was that the church had initially. And then we will show you a little bit. Oh, shit. Where is this at, man? Okay. I'm going to go ahead and share my screen. So what they had originally thought about, come on, there we go. My internet's slow. So here's the church right in the middle of this thing. And what they had originally thought about doing was doing 3 phases of apartments totaling about 200 units. Here, phase 1, phase 2, phase 3. Since we've gotten involved, the church has decided that their mission could be better served if they had church somewhere else, raised the church, tore it down, and came up with a total development for all multifamily, and then have some 16,000 square feet of small box retail along the frontage of Mayfield Road. So it'll be 2 buildings up here where phase 1 and phase 2 are, totaling about 8,000 square feet each, so that they can have some space to lease for additional income and et cetera. And then we'll design 256 units to flow through the back of the property. What we have done thus far is and what we typically do when we get involved with a client, we find out exactly what they would like to see, what their visions are, and then we contact our engineering firms, and we get them to put us to proposal together. Here's 13.6 acres, blah, 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 256 multifamily units, 16,600 square feet of retail space. And then we get a soft quote or a pretty hard quote based on all of the things that are necessary to take a piece of dirt all the way up through a development. So here's our due diligence. We got environmental assessments. We've got asbestos containing material surveys on the dirt, geotechnical report trying to see what the soil is made up of, altar surveys, topo surveys, which give the topographical view, the heights and the lows of the land, tree surveys, planned development exhibits, all the things that the cities need when we put this stuff together, because they don't just let you go build apartments. They need to see what this whole development is going to look like, all the way down to freaking landscape plans and et cetera. We come up with a preliminary plat, which means that this particular site will have the buildings on it the way we think they should be designed, and we'll get our architect to do that. Then we got a final plat once it's been approved by the city. This is typically about a 6-month process. Included with that, we've got construction docs that they'll give us, paving plans, grading plans, erosion plans, drainage area maps. All of those things go into, that's even before you even get started. We hadn't even consulted the architect yet. Stormwater pollution, all of this stuff. And so I'm not going to say it's impossible for everybody to know this, but if you don't know this, this is why you hire a consultant to do that. This particular process is about $229,000. We'll get into that here in just a little bit. And then there's all kind of additional work that we can get the engineers to do. But today we're going to focus on this Proforma. So Kent, I'm gonna fix it so you can share. And I think you started on it. And then what Ken asked me, and Ken, Ken lives out in San Diego. He is an affordable housing guy. That's exactly what he wants to do. He started doing this a couple of years back. He's got a dynamic podcast, Investing with Ken all about affordable housing. And also he has some Airbnbs, so he's actually been able to retire himself and his family and work from home by just operating his Airbnbs. And now he's focused on affordable housing. He's become a part of our team here at Springboard and Hope Housing. And just dynamic having him as a part of our team. So advanced sharing options. Okay, Ken, I think you can take it away now.
Sounds
And then
good. Thanks for the introduction there, Alvin. And
Yes,
if you
sir.
guys ever want to check out our podcast, Alvin was one of their guests, and Alvin will probably be a guest co-host frequently on the affordable housing and real estate investing podcast. You check us out at youtube.com/@Kent_HE. And then don't forget to check out Alvin's YouTube channel as well. We both post a ton of content there, specifically around the affordable housing realm. Again, our goal is to remove the fear so you guys don't feel like you're on an island by yourself when you're going down this road of trying to becoming a affordable housing developer. So
hey, Kent, I'm going live on YouTube right now. So if you want to give us an intro to what we're doing, that'd be awesome.
yeah, you got it.
Let
Let me know when you're ready.
I think we're good.
Okay, so today we are going to go through a pro forma for a project that we're building on for roughly a little bit over 300 units, if you include the third and fourth phase for the senior living housing. And what I'm going to do is Peggy, Alvin, and myself, we're going to go through and build this pro forma. I'm going to ask some elementary questions just so that everybody on the call can also follow along, and feel free to ask any questions, pop in there in the chat or on, I'm assuming, Alvin, you're probably on IG Live too, but if you notice any questions, just pop them in there and we'll be happy to address any questions, because this stuff is complex. There's a lot of different elements and a lot of judgment and a little bit of art involved when you're thinking about coming out with these plans. So we're going to go ahead and I'm going to bring you guys up. So what we have on the screen here right now is a pro forma. This is a pro forma we've been using to build out some of the estimated net operating income, but also what can we reasonably project to get from our tax exempt bond financing. Now, the first thing we're going to do, and I am going to pull up a website. This is called Novogradac, and I pulled this stuff up in advance so I can be a little bit more efficient with everyone's time that is following us on this call right now, because otherwise you guys will probably just see me Googling a lot of different items. So the first thing you're going to want to do is go to Novogradac. You can just do a Google search on that piece. And from there, you can plug in the county that your property is related to. You can plug in the different AMI levels. So typically what I do is 50, 60, 80, 100, and 120. And this allows us to see what the rents look like by bedroom count at each of the different AMI levels according to that county. So you can see right here, the county for this property, since it's Arlington, is Tarrant County. The MSA population, typically we look for areas where the MSA population is at least 250,000 people or higher. And that just comes from what we would like to see, but also what some of our investors would like to see. So when you're thinking about, hey, is this a deal? Is this not a deal? We have plenty of rules of thumbs where it says like, hey, you want the AMI to be at least $80,000 or higher, which you're going to see right here on the screen. Let me see, I can zoom in a little bit just so people can see.
Hey, Kent, while you just mentioned the 60 and 80% AMI, you want to give a little backstory about what that is and how we get there?
Yeah, so 50, we set aside 50, 60, 80, but based on the IRS section code 103, and full disclaimer, Alvin, Peggy, and myself are not CPAs. We're not lawyers. This is not financial advice. This is not legal advice, but we put in 50, 60, 80 because when we set aside half the units for affordable housing, which means we set aside half the units for folks making between 50 to 80% of the area median income, that is how you qualify your bonds for tax exempt status, which means the simple analogy to use here is when you buy a single family home, there's typically a primary mortgage associated with your property. We're using a similar financing mechanism, but it's using tax exempt bonds because we have essentially raising capital through tax exempt bonds, and those tax exempt bonds are used to finance the construction of affordable housing developments. However, the interest earned on those tax exempt bonds are exempt for income taxes because we're setting aside half the units for affordable housing. And by affordable housing, it's really based on people or households making between 50 to 80% of the AMI. Anything else you would add there, Alvin?
No, Kent, that was good. And I'm sorry, I was talking to IG, so I really didn't hear you, but I know you covered it really well.
Peggy, anything else you would add to on your side? Oh, you're on mute, Peggy. In case
No, Kent, great job.
All right,
See,
awesome.
Told you did it. I knew you did it.
I listened to you enough, both of you. All right, so now that we've got these rents up and running, the next thing we want to do is take a quick look at the unit count. And let me see if I can pull this sheet up. And the first thing we want to do is I have a older sketch of the preliminary plan. When you saw that the plan that Alvin brought up earlier, we saw that there was like sort of two U's, right? Almost like a big square or rectangle, whatever you want to call it in the geometrical world. And I essentially counted up how many units we had for the 2-bedroom count. So you see all these red ones, those are your 2-bedroom properties. We have a few 3-bedroom, 2-bath units in this property. And then we have the 1-bed. So essentially 8 units of 1 bed, 1 bath, 4 units of 3-bed, 2-bath, and the rest of these units are 2-bed, 2-bath. Now, this was a preliminary plan for the units when we first discovered it, and when we first engaged, I believe it was Henry on this conversation to draw out what we can possibly get and what the setbacks might look like, et cetera. So we have a team that we engage regularly to help us understand, like, hey, what are all the setbacks associated with this area? Where are flood zones? Are any wetlands associated with this property? And we try to come up with a preliminary sketch that allows us to build this Proforma that we're doing with all of you today to see whether or not this can be a deal, looks like a deal, or whether or not it requires additional investigation. So again, because of how large these projects are, you really want to spend a good amount of time upfront so you don't burn too much capital on a project that might not be feasible or that a project that might not work at all. So this was the plan I got. Alvin and Peggy, I'm not sure, do you guys have any other updated sketch of this property? Because when I first looked at this plan, I multiplied by 4, but it didn't get us to the unit count that we were talking about, the 256 units. So anything for you guys to add there, Alvin?
Yeah, they didn't, because this was the initial plan, this will be totally scrapped. I think the
Okay,
only
got it.
thing that'll be existing will be the 2 retail buildings.
Okay.
And so within that 256 units, we can basically come up with any floor plan or unit count that we want for the 1, 2s, and 3s.
Okay, cool.
And they'll follow
but
our lead. We got the 256 units from the engineers because they went out and checked what the county would allow for density. And so they came up with 256 units on 13.66 acres, which is roughly 20 units per acre.
Was that including the senior living in the back too?
Yeah, that includes all of it.
Oh, I see. Got it. Okay.
So I don't know that we will have a senior living component here. They're more interested in income now, and that may flush out, Kent, as we do the market study. Because once we do the market study, if we show that, hey, this is there are several other complexes on Mayfield Road, it may be a situation where this would be the best deal for a 256 unit, 55 and up community totally. And so those will be some things that we'll look at as we order that market study.
Okay. 256
and so
includes the front and the back. Got it. Go ahead.
Let me add to that. And so since we're going through this right now, building out a Proforma for 256 units, we're assuming affordable housing. We're assuming that this will be for basically any resident that qualifies based on a 60% area median income, 80% area median income, or at market, because we'll have several set-asides for the 60s and 80s, and then we'll have several set-asides for the market. And what I mean by that are the rent levels. And Ken will go through that as he does this Proforma. But we're just assuming all of this. We've already engaged the engineers. The architects will be next. But the first report that we do is a market study. And we put out a deal to the engineering firms that do these market studies and let them know that we are assuming building 256 units. We assume that this deal will be all affordable housing or workforce housing. The area median income, Kent, what was it in that market over there?
It was 97,700. Yep.
So you're in a great market. And then we'll find out and ask them to let us know, based on this market study, the most feasible way that this thing can work for us. Meaning, if it's 55 and up, is it going to be better because of what's already in the market to do something like that? That could be all for 55 and up people. The rents may be higher for that, or it may just turn out to be just the way we propose it. So we've got several different strategies for putting this together as we walk through it. And this is all for our client. Okay, Kent, I'll be quiet for now.
No, you're good. So what I went in there while Avin was just quickly talking was, and you guys have seen us doing this live. Like this is not pre-scripted or anything.
Right.
This is the fun part. You guys actually get to see the struggle, the questions that we ask each other and deliberate with one another. So what I preliminarily did before I got on this call was try to save the team a little bit of time. I already went into the Novogradac website. And if you look at the screenshot that I posted right here, I'm essentially just translating the rents that we're seeing the 50%, 60%, 80%, 100% onto our rent assumptions. And what I'm doing right now is 60% for a studio is 1,026. You can see here, 60%, 1,026. So I'm not going to do this for every single cell, but I want the audience to understand where are we getting these numbers from and how we're inputting them into this pro forma right here. So 1,026. And as all these assumptions, excuse me, kind of flows out, then I have all my rent assumptions are in the highlighted area. Now, when I first looked at this property, let me kind of zero out some of these details. I am essentially getting to around 258 units right now, which is pretty close. I just deleted all the 2-bed, 2 baths because I thought initially we were going to have even more units in the back. But based on the conversation that Alvin and Peggy just shared with me, we're going for 256 units. So I'm just going to go ahead and just reduce it a little bit here by another unit. So I can get to 256 units. Now, these are a lot of studios, a lot of 1-bedroom, 1-bath units. So what proportion, Alvin and Peggy, do we think our studios, 1-bed, 2-bed, and 3-bed counts should be in this area?
Ken, I would probably leave out the studios.
Great.
And
is this a market? So I'm not as familiar with this market, but I know you guys live in Dallas. What are the most popular type of unit counts? Is it 1? Is it 2? Or is it 3s typically?
Mostly 2s.
Okay.
Yeah. More.
Okay.
Now we can have a really good concentration of. Let me see. We got 256 units. Ken, I'd say we ought to have 10% of those as 3 bedrooms. So roughly 25 3s, maybe.
25 3s. So let me double that. 8, 16, 8, gives me 32, 6, 6, 12, 13. No, let's make that 12. That gets us to 24 3-bedroom units.
Maybe 92 1s.
92 1s.
You can round that, you can round those 3s up or round them down to 24 or 26.
24, 26.
Either one.
The 3 is going to be at 26 right now.
Okay. 92 1s.
Delete all the studios.
92 plus 26.
We got 80.
Is 118, 256 minus, and that'll leave 138 2-bedrooms.
You said 138?
Yep.
Okay. Six more.
And so when we're doing these set asides for these units, there are a couple of ways that we can do this with these tax exempt bonds. This is our preferred strategy to finance these. We get really high leverage. We can almost get 100% financing on these affordable deals using the tax exempt bonds. Yep, I said it, 100% financing, 100% of costs. And so what the requirements are, if we use, some issuers only require us to set aside 50% of the units for 80% AMI. So if we've got 256 units, 50% of them will have to be set aside for 80. In another situation, we would have an issuer say, well, we need some 60s and some 80s. So in that situation, what we typically would have would be 25% at 60, 25% of the total unit number at 60% AMI. We would have 50% of the units at 80% AMI, and then we'd have 25% of the units at market. And so if you've got 256 units, 256 times 0.25, we'd have 64 of those at market. Now, okay, you say 64 of those 256 units are at market, but do they all have to be the 1-bedrooms or the cheaper rents, or can they be the 3-bedrooms at the higher rents? And so when we're doing this to be politically correct, you don't always make your set asides on the cheapest units, even though that would be great because that's, we're losing,
Mhm.
technically giving up more to the resident. So we spread that between all 3 floor plans. So some of these are going to be some of the markets are going to be in the 1s, some are going to be in the 2s, and some are going to be in the 3s, as you can see the way Kent did that. Okay, Kent, take it away.
Yeah, so you mentioned you went to 25% of the units to 60% and then 25% at the market rent. Why is that? Is that because that was like the churches or the clients' preference?
The issuer.
Oh, that's
And
what the
so,
issuer wants. Okay.
yes. So Public Finance Authority could issue these bonds for us. They are low-lying fruit. They'll basically give us any amount of bonds that we ask for. And what they will tell us is that the bonds are not worth anything until somebody buys them. So if somebody buys the bonds, then guess what? Then you know that you've got something that's worth something. So they'll give us $1 gazillion worth of bonds. And then it's our job to put together a pro forma and a business plan that works to where somebody would want to come in and buy the bonds. So that's exactly what we're working through right now. Is Kent's just moving some of the numbers around to get in line with what the issuers would want. And then we start here, and then he's already got the area median income at $97,900. So let me tell you what those 60s and 80% AMIs mean. And I think Kent did it, but I'll use a calculator. So based on 97,700 times 0.80, that's $78,160 that the 80% area median income makes that number or less than. Okay. So based on what HUD says that everybody in America should use for a housing standard, we should not spend more than 30% of our income on housing. So if I make $78,000 a year times 0.30, that means I've got an annual amount that I spend on housing around $23,400 per year. Divided by 12 means I have $1,954 a month to spend for housing. Based on that, they also have a utility allowance calculation because it's based on housing, not just the cost of rents, but what does it cost to live there? The electric bill, the water bill, and et cetera. And those things are typically going to be about 8% of that rent amount. So if you've got $1,900 that they can pay in total housing costs, probably $1,825 of that is going to be for rent. Now, based on that 80% AMI, our rent amounts on that pro forma I'm looking at right there for the 3-bedroom is $1,954. Well, they can pay $1,954 based on that 80% AMI. So we're golden. But what if our rents were $2,500 a month, just like the market rate is, $2,442? Well, if we don't have any more set asides for the 80%, we can actually have a person that makes $78,000 a year with a housing voucher from the housing authority that will pay the difference of their rent. So when you're talking about providing workforce and affordable housing, we do still take Section 8 vouchers in these developments. But you see that the majority of the people make close to $97,000 a year in that market. And if we're setting aside 50% of these units, most of our residents are going to make somewhere between 60 and 80%. So they're going to make close to $60,000 to $70,000, $80,000 a year. And they could still have a Section 8 housing voucher.
And that's exactly right. And one of the strategies we disclose with our clients is if you have a relationship with the local housing authority and say, hey, we want to come in, we want to provide affordable housing. Do you have any project-based vouchers? And just for the audience to understand, housing choice vouchers are similar to Section 8 vouchers where they travel with the guests to wherever they want to move. Project-based vouchers stay with the building. So if we believe in creating a path towards success for the folks that are living in our units, eventually they might get better education, get better jobs, get better progress in life. And then all of a sudden they no longer qualify for the subsidy. They can now move on to their own market rent units outside of the building, et cetera, et cetera. But the next family coming in will still get to reap the benefits of the allocated project-based voucher. And what's really important for that factor is if you get those allocated project-based vouchers, you can now underwrite this pro forma using the market rate rent because you have that subsidy. And that will allow you to get more confidence in your underwriting because you essentially have a guaranteed rent amount from the government that will be paid on time every single month, regardless of the situation, whatever might happen with the tenant. Even if they lose a job, the government will still step in. So hence the recession-proof investment strategy associated with affordable housing and why it can be one of the most profitable real estate investment strategies at the same time combined with the mission of helping others.
Yeah, based on what you just said, let me clarify that. So let's look at the 1-bedroom units at $19.55 for the market rate and $11.73 for the 60%. That's $800 a month difference roughly. If we had a project-based Section 8 voucher, which HUD doesn't issue those anymore, but you can go to any local housing authority. They have congressional authority to issue 25% of their total housing vouchers in that city or in that county to any developer or a complete plethora of developers. So if you were able to go to them and say, look, we're building 256 units. We need some housing vouchers for half of those units. Our residents are going to make X. They're built for 60 and 80% AMI. We could fully underwrite this deal, assuming a $1,710 a month for that 1-bedroom unit. I'm sorry, the $19.55. We could use that $19.55 for the full amount of the rents, which makes $800 per month flow back to the bottom line of this deal, which makes that, as Kent said, one of the most impressive strategies for doing this.
That's exactly right. So Alvin, what we have right now is we have 28% of the units are at the 60% AMI.
Okay.
In totality, we have 74% of the units that are between 60 and 80% AMI. Do I need to bump up the unit count just by a little bit just to make everybody happy, or is this close enough, you think, for?
That's close enough for now.
Okay.
That's close enough for now. Now, Kent, what you've done is you've built in the rents, you've put in the unit counts. Go to the top of your model because I saw the total construction numbers, and let's talk about how we came up with that, just to kind of give everybody because now what you're going to see is you're going to see a total construction number of what it costs to build this. And then you'll see a total capital stack number of what it costs to build it, what it costs to finance it, and then what it costs to carry it until it starts making money, which will probably be closer to 65 million total number. And then we will get to a place where we see if these rents will flow through and make this thing work or not.
Yeah. So for the square footage, since we didn't get those numbers yet, I copied it from the same project we have.
That's good enough.
On the cello. So
that's good enough for now. Yep.
Okay. This way, everybody understands like where we got these square footage numbers. Typically, if you were to engage with us, we would hire another person that can do a conceptual plan for very simplistic terminology, where they will look at the lands, they'll do some diagram drawings and essentially try to estimate how many units can fit, assuming all the roads. You just kind of play around it on software and try to essentially understand like how big of square footage are these units. And at 1,000 square feet per unit for these 3 bedrooms, like they are decent size. They're not very, very tiny apartments by any means here. So
yeah, while you're doing that, I'm gonna open up this thing and kind of show. Let me share real quick. Can I share mine real quick?
Yeah, go for it.
Okay.
See, I told you guys this wasn't scripted. This is the fun part about all this stuff.
This is what we did. Those floor plans Kent showed are based on this building design. So what we've done is we've designed a 4-story building with elevators that can basically fit anywhere we want to put it. Why this thing's taking so long to open up. This is the other side of it. Just a beautiful structure. So this does not look like affordable housing. This looks like something that if we lived in apartments, most of us would want to live in. That's why we wrote the book called The New Look of Affordable Housing. And you can get that on Amazon. but these are our buildings. And so those floor plans that 605 square feet, I don't have the interior floor plans, but that sounds small, but the way they are totally designed gives you a really open floor space, really nice, and elevator served. I mean, just a really, really great looking building. So we're excited about this. And this thing, like I said, can go just about on any development that we do, because this is what we've got, this footprint, and we're doing affordable housing, right? So every dollar that we save saves us money, saves our client money. And so we can actually reuse these blueprints over and over again. Our architect still has to stamp them. Yeah, there's still some expense associated with that. But when you're looking at from an engineering cost of the buildings, the dirt and everything, along with the construction docks, we're somewhere about 7 to 8% of the total construction costs. And on Kent's number a minute ago, what do we have? 48 million or so at the top of that thing. So if you're looking at 48 million times point, let's do 6%. Times 0.06. You're looking at $2.5 million roughly for blueprints, engineering, and et cetera. And so when we can reuse documents over and over again, it just helps save probably close to $1 million for our clients. Okay, Kent, you could take it away.
No problem. I think we had a question from Daryl. Peggy, I see you coming off mute. I'll let you go for it.
I was gonna say Daryl asked a question.
Go ahead, Daryl. Come off mute.
I was just curious. I know you and I know from Apex, so I'm late to all this, but I know that you said that looking for your clients. Do you do anywhere you're a partner on these deals? Like you're doing this for yourself?
We're doing these for like that land you got in Sugar Land. We would do this for you. We'd come alongside you. We'd be your consultant. We'd do all this work for you. You just pay us, we got a consultant agreement, just pay us the fee for that. At the end of the day, when it's fully entitled, fully blueprinted, if you want to build it, you can. If you want to use our builder, you can. If you want us to be a part of it, we can. If you want us to be a partner in it, we can. But we're, I've said we wanted 20,000 units, and we really figured out the best way for us to get to 20,000 units is to do it for everybody else. So like we're doing those 256 for the church. Your deal down in Sugar Land, we could probably get 600-800 units down there. That would be for you. And so that we count all those numbers towards what we want to do as part of our mission.
You got it.
And Daryl, just in case you were asking, we own the units, like the 400 units we're building in Princeton, the 185 we're building in Wisconsin. We are our own partners. That is our development. We have partners with those deals.
That is correct. Good job, Kent.
Just to make sure, sometimes we miss out on certain words on questions, and we want to make sure we clarify. So we got the rents in here now. And Alvin, what is the construction per square footage now that you might be estimating for this project, considering it's in a similar market as Princeton that we use?
Well, Kent, what I had used for a total capital stack number is about $200,000 a door.
$200,000 a door. So I'll bump this
and
up.
So that's about 51 million. I think if we used a number for construction of, call it 190 to 200 bucks a foot, we'd be safe. And those are some really nice finishes in that building. And so I don't know if you want to share, we could see what you're doing. That'll get us, and then we'll
let me
just
share back screen. There we go.
And we'll see what it looks like.
So if I were to get it to 51 million, just because we don't have the updated square footage numbers, that gets us to 51 million. I'll put it at 250 for now.
That works. And that 250 a foot covers the building, parking lots, all the stuff that we're talking about. And if we're looking at, I said, yeah, that's about right. And then what we'll see flow through this will be all of our expenses, and then our interest carry and et cetera. That'll be toward the bottom of this thing.
Okay. So now that we got all the rental assumptions out, just to kind of recap really quick, we got the unit counts based on the conversation. We got the rental numbers from Novogradic. We just plugged in the $250 per square foot, which includes auto parking and et cetera. Now we just got some items here for laundry, which we have an assumption for $65 per unit. We have covered parking at $125 per unit. We got an amenity fee for $45. trash reimbursement at $30 per unit, $35 for utility, and then $75 for internet. Any sort of changes to these assumptions, Alvin or Peggy, based on any sort of the more recent numbers that have come in?
Yes, I would say on the parking, what they are only requiring for us, Kent, is 50% of the parking be covered.
Okay.
Laundry vending, we've taken it up to $70.
Okay.
And what that is on a laundry vending, we're fully equipping these units with washers and dryers. Why are we doing that? Well, initially we were doing it because we were building these as all bills paid. But I think based on what we've seen, we're not going to do that today, but it gives us the ability for another income stream. So if we can put some really nice new washers and dryers in affordable housing units, everybody doesn't have a washer and dryer, believe it or not. They don't have to drag their laundry to the laundromat. They'd be more than happy to stay here and probably for a very long time until they got ready to move out. The amenity fee, that amenity fee pays for landscaping, swimming pool, flowers, all that stuff. You know, that's a new amenity that we really just started seeing in the last few years. That's the owner's responsibility, but you know, it's just become so common now that we can literally add that in as an extra income line item. The trash reimbursements, that's a valet trash service. Set your trash outside the door. We can hire a valet trash company for about $15 a month per door. Pick the trash up, or we can get our maintenance guys to do it. And in a new situation like this, where you don't have a lot of maintenance, our maintenance guys are going to be doing more porter work and more this kind of stuff because everything's brand new. Utility reimbursements, that's called a RUB system. Basically, we are billing back the water, and that's a $35 unit average. 1 bedrooms may be 20, the 3 bedrooms may be 38, but pretty good average right there. And then Kent, what's that last one? Internet reimbursements, perfect. And what number? 75. And so what we have there, that's a dope number. We have the ability to contract cable services with Spectrum. They'll give us 156 channels, all streaming, with 400 meg up and down internet for $38 per door. And we can monetize that at $75 per door. So we'll make, you know, about $30-40 per unit on that. And you can see the income associated with that. Everybody has internet. And so if we can make $40 a month on something that everybody has, all of that stuff goes to the bottom line and just helps this thing work really, really good.
That's right. And Alvin, did you want to speculate what the commercial or retail space might rent out for right now? $1 per square foot? I think we had 16,000.
That's a good number. I think it's going to be way more than that, but let's just assume that for right now.
Okay. I like being conservative.
Yeah.
All right. So that allows us to get all the numbers here on the revenue side. And the next thing we'll do is we'll probably go into the underwriting tab to go through certain number of expenses.
Yep.
So what we've covered so far was everything on the prior page. That gave us all the revenue numbers up top. And now let me take out this little watermark here just so we can take a look closer in here and zoom in. So when we first looked at our G&A expenses, we have a 400 unit building in Princeton, and these were the numbers that we typically have for 400 units. So Alvin, would we want to take down some of these G&A and marketing expenses slightly or leave them as is?
Actually, G&A probably can't, you can probably do 185 on that. Let's see, 256 times 185. 45,000 on that.
45,000 on the G&A.
Okay. Marketing and advertising, I would say 30,000 on that. 30,000 on that. And miscellaneous expense, that's great. And so what we're looking for here, guys, is really just, this is a really great area, marketing and advertising, $30,000 a year. That's roughly
Is it-
$2,500 a month in all kind of advertising. So that's, that's a good number for a market that needs housing really, really bad. Professional
Is there
fees
a per
typically.
unit count that you typically try to target, Alvin? For
I don't know that equation, Kent. I just divided
Mm-hmm.
that number. And what I typically look at is the per door cost, because our underwriters need us to know, what's that, $176 per door per year? That's a pretty good number.
got it.
And then moving down into the payroll, so we got 256 units. Typically what we have is, 3 people on the inside. What's that?
This is probably too high because
2.5.
originally I was, I think what I had it before was roughly, I was assuming 300, almost 400 units, 378 units. So we need to lower this stuff.
And so typically what we have per these newer assets is going to be 1 person per 100 units on the inside, 1 person per 100 units on the outside. Ken, I'd leave that manager at about 70 in
Okay.
this market. Yeah, 75, that works. Either
Okay.
one. Assistant managers 50 is good. Senior maintenance is good. Maintenance supervisor, take him to 45. I take that leasing agent to 35. And that porter I'd take to 32,000. Okay, that's 377, 520. And look, what our lenders need to see for payroll is somewhere between $1,200 and $1,800 or $1,200 and $1,600 per door annualized. And what we're looking at right here is 1,475. So that's straight down the middle for what we need to be.
You said 1,200, 1,600. You said, right?
Yeah, per door.
Okay. Per door. That makes sense.
Utilities, those utilities are pretty high, Kent. What we're gonna have here basically is just house meters and house lights. Try 40,000. That's a good number. Okay, repair, maintenance, make ready. Those numbers should be about $350 per unit annualized.
Okay.
So we got 256 times 350.
Roughly 90K.
Yeah. The first few years of this repair and maintenance, we should not spend anywhere close to that. So what you have is you will have monthly deposits going in at 90,000 divided by 12 going into your repair replacement account. And typically what our lenders like to see is $1,000 per unit in that account. So in some situations, they'll charge you that $1,000 per unit on the front end of this, 256,000 to put into that account. Why is that? So that the minute your tenant moves out, you don't have to scrape up money to get the unit fixed. You've got $1,000 sitting there to repair it. It shouldn't cost more than that. I mean, surely not. If it did, that's a management problem because you did not go into your unit or you didn't have those units inspected enough to where you allowed that tenant to tear your unit up to where it costs you more than $1,000 to put it back together. There's no way it should cost it. Every 6 months. Pest control in Texas, yeah, that's a good number.
$78 a unit. Okay.
Typically, they charge us $4 per unit per month, and then they would treat the units quarterly. So if you got 256 times 4, that's $1,000 a month times, so you're right at 15,000. So that's perfect.
Yeah. Just before these numbers were for 400 units.
6 times 34. 256 times 34 equals times 12. 104, Kent. 104,448 for the internet. And that's about $33 a unit. Landscaping, that's a fair number at $5,000 a month.
sense.
Mm-hmm.
I'm just typing it out so that people following us can also take notes. Got a property manager.
management fee, make that 3%. Now,
Good idea.
real estate taxes. This thing will be 100% exempt. Today, the land is owned by the church. This development will go into a single member LLC that will still be a non-profit situation, so it'll remain exempt from taxes. If not, we've got a 3.1 mill rate in Texas, and I would probably base that off of just the construction amount of 50 million. It'd be about $1.5 million a year in property taxes that we are exempted from. So we can leave that number out.
That was
Yeah.
crazy. But it's good for people to know.
Yeah, that's a huge affordable housing. So there got to be some benefits to make people want to do this shit, right? Oh, I'm sorry, I shouldn't have said that out loud. But this really does help these units work. I mean, it really does allow us to provide a service that the residents wouldn't have. Okay, the property and liability insurance, Kent, let's take that to about $850 per door. Equals $217.
Yep.
Issuer fee. Now let's put as a total number for all issuer fees and et cetera, make it 1.3 million. But can't, no. Take that issuer fee out, because that if we put it there, it'll populate that every year.
Got it. Understood.
Okay. And so we'll put that on the trustee fee is perfect. Replacement reserves. Yep. Perfect. Okay. Let's go to your budget and see what that looks like. Farm out 1050, blah, blah, blah. Okay. Contingencies, developer fee, 7 million. Yep. See that number? Developer fee, 7 million. That's what's made on the front end of this deal by the developer and et cetera. Consulting fees, Kent, you could take that one out of this one. And the reason we took that out, on one of the deals that we had a consultant that we hired that we needed to pay, and now we're the consultant, so we don't get paid that way. We do have a success fee and and it'll come from a portion of that developer fee. And then what you see, the reserve funds, 15 million cap one, and then debt service reserve fund. Kent, I would probably make that total number, make that about 8 million and 2 million. And now we may have to come back and adjust that, because what we'll do is we'll look at the cash flows and debt service. Go to your debt service number now. Let's see what that looks like. And then what we'll do is we will cover. Okay, yeah, go to the top. Go to the top. Yep. 3 million interest, debt service, 3 million, 3 million. So yeah, we got 6 million. You could take that $8 million number that we got there down to 6 million. And so what that'll do is give us 2 years worth of debt service there. And then we got a debt service reserve fund. That is, so what we're assuming here is that our debt service payment based on interest only was 3 million a year. So we got 2 years worth of payments already covered. And then with the debt service reserve fund, that money stays there because 5 years from now, and then that money's released back to the developer after 5 years. But 3 years from now, what if your occupancy drops to 85% or 82% for whatever reason? You've got $2 million that'll help you cover any debt service shortfalls. And then after 5 years, that money's refunded back to you.
And I would jump in here and just
Go ahead.
help qualify folks to understand in your typical what you might hear in the real estate space is your value add multifamily strategy, where you're buying an asset, you have to increase rents by first either kicking the tenant out, renovating the property, and then adding rent or putting out and renting the units at an incremental or increased rent rate to justify your business case of the property that you just purchased, and you're trying to increase the rent. That has risk in of itself, because what if the market tanks, or what if the rent rates don't go up as high as you expected? What if the GP isn't managing the funds or expenses properly? You might get very, very low cash flow in the first year, 2, 3, even 5 years if the execution of the plan does not go according to plan. Here, we are setting aside the interest in a reserve account that gets paid out by a third-party trustee, regardless of how the asset performs, because we're setting aside and raising the capital in advance. So even though we're paying 10% on our tax-exempt bonds or whatever interest rate we might agree on, that is a rate that's already predetermined, and it is not necessarily contingent on how the asset is performing, because we've already set aside those interests there. So very, very big difference from your multi-family value add scenario. So when, again, this is not investment advice, but if you were to go out and help folks understand their entire risk on a relative basis compared to other deals that they might get, especially if you are raising capital from accredited investors who are getting sent these value add multifamily deals all the time, this is one way it's different. In the first year, you are getting the 10% because it's already set aside, and you're going to be paid out by a trustee, not by Alvin or Kent or Peggy. So Alvin, Peggy, and Kent can't say, oh, we're having a bad year, we're not going to pay our investors this year. That's not the case there. The third party already has access to the account, and you're going to get paid as an investor. Hopefully that helps differentiate what folks on here might be listening to and what available investment options you have for not only yourself and also, but also your investors.
That was good. And so here is what you'll see, where we've got the placement agent, $1.5 million. Can you go to the top and let me see what that column says up top? Equity contribution.
Oh, yeah.
Okay. Oh, and then that 100 million. No, we're gonna change that to 74 million. And then what I would do on that amount, do 8 million there. And that's a little over 10%.
Yeah. Right.
So we got $293,000 left over. You can make it 7,370,000 if you want. Or yeah, or reduce that.
So you gotta bring 300 grand close.
Man, zero it out. 7.7.
There you go.
Okay. Man, we come to the table with $6,000. And really, so what we did here, now go back to the top, Kent. So what we'll do is we'll pick up the phone and get an issuer to issue us $74 million in bonds. What this says is we need to bring roughly $7 million, $7.7 million in equity to the table, almost 10%, a little over 10%. Now, because we are using tax-exempt bonds, Kent mentioned it a little bit earlier that we can have accredited investors partner with us to raise that 7 million, or we have Kent found a fund that buys nothing but tax-exempt bonds in the B position. So we've got buyers for the bonds of the A, the 223A series. Anybody will buy those first lien bonds. But the equity contribution, instead of us having to bring 7 million to the table, we've got a company now that buys straight B bonds placed in the B position for affordable housing units. So we can technically get 100% financing on this transaction by bringing $6 million to the table. Now, all of that said, we haven't looked at the cash flows yet. So now what we have to do is get over to the cash flow tab.
Yep.
And see if that flows through. But before we do that, Margaret, you got a question?
No, Al, I was just clapping for you guys because
Oh,
I'm
okay.
content. I'm loving this.
Okay. Thank you.
Hey, Alvin, do we need to change any of the interest rates on any of these bonds? I'm at the underwriting tab,
6 3/4 on the A's.
6.3.
And those are good for those.
Okay.
And I guess Ann will tell us what those B's will cost us.
Got it.
So here's the cash flow. Now what we need to do is see if that $74 million number works with all of the fees that we got associated here. And so when we're looking at the debt service coverage reserve, that DSCR line 64, year 1 and 2, we don't have any income, so we understand that. Year 3, we've got a 1.46 debt service coverage, but that is skewed because why? Can't go on up to the top. We've got some income coming in that vacancy loss, that's good. Bad debt is good. Other income.
Well, this vacancy loss is a little high.
Where
Times 12.
let's go up to 3% rent growth, revenue growth, 3%. Yeah,
We're assuming
vacancy
75%
loss.
of units come up.
Why don't you change that, Kent, to after year 2? Because this is like an 18-month bill. I think
see.
by the end of year 3, we'll be just 5%.
Okay.
That'll help. But
There we
all
go.
that did was raise the income. So what I want to see is why our debt service coverage on line 64, we must have had some income come in year 3 that we didn't in year 4. Unlevered cash 4.5, I don't see it. Okay. Oh, I see what it, well, no. Okay. I see what it is. In year 3, we have that 2.497 coming in from the debt service reserve fund. So it's paying that much towards the debt for us, where after that's paid, the next year we're losing $213,000 in year 4. So to combat this, there are a couple of things that we have to do. We've got to lower our construction costs, lower our fees, because where we need to be by year 3 is where we are at year end, 115 debt service coverage. That's 9 years out. So Kent, let's go back to the top and let's change that bond amount, change it to 65 million and see what happens.
Almost.
Okay. Take it down to 60 million. Perfect. Now you can take it up a little bit, take it up to 62 million.
And just so people know what we're doing, we're trying to make sure this DSCR ratio gets above a certain point, because
Above
otherwise
115. Yep. And so now, Kent, what we've got here, now go back to the top. I'll go back to your, yeah. So we've got a total number of, because it's not even counting that $7 million into our debt, right? Because that's equity. So you can basically take that out and yeah, just take it out. And okay, so we're at 62 million. What is your construction cost on here?
250.
Okay, 51 million. And that's 200,000 a door. All right, 51. So what we need to do is we've got $11 million to play with in fees to equal that 62 million. So let's go back to our underwriting tab or our budget tab and see where we've got more than 11 million. Well, you just reduced our developer fee. That's a big chunk of it. FF&E, as furniture, fixtures, and equipment. That typically covers blinds and et cetera and blah, blah, blah. You can take that to $1 million. Let me see, 256 times 0.5. Three. Yeah, okay. The contingency, what's that, about a 5% contingency? That'll-
This was from the 400 unit build, so we probably lower this.
Okay,
You want to be 5%?
yeah,
2.5. What was it before? Oh, it didn't change.
that's kind of
much.
close where we were, right? Yeah.
Yeah.
And then soft costs, you can take that all the way out because we already built those in down the cost of issuance. But the
Oh.
soft cost here, what was that number?
It was 3.14.
Leave it there. That's our blueprints and et cetera and all that stuff that we talked about at about 7% of the construction cost. Developer fee, okay, 6
do
million, 2 million, 8 million.
7%. If I do 7%, what is that equal to? $3.5.
Okay,
Yeah, it was 3.14. So we don't want to increase that.
no, we can leave that. Okay.
Okay.
Hey, go back to your debt service tab since we lowered the debt amount. Maybe that 3 million is less. Yeah, that's 4 million. Okay, that's a good number. 4 million two instead of 6 million on the.
So lower that one, right?
Yep.
Top one.
Total use of funds now is what? It should not be 77 million. Because we lowered all of that. Let me see.
Oh, the purchase price.
Oh, purchase price. Take that out. That's zero. They already own the land. That's a big one.
Huge.
Huge. Developer fee, okay, there's your capital reserve fund, blah, blah, blah. Total construction cost. Hang on, Kent. 256. What is your square foot number on here? Go to your, yeah. What's our total
Whoops.
square footage?
205,000.
Put for your total cost of construction, 205,514 times 37 million. There you go. That's the number. The 200,000, you can take it up to 40 million. The 200,000 a door is inclusive of all the fees. So now when you go back to your number, it should be spot on.
For
Okay, we're 3 million short there. Or okay.
well, this is because this should be lower.
Mm-hmm.
2.8. There you go. 2.8. Contingencies at 5% of the construction costs. Soft cost at 7% of the construction costs.
That construction number 41.8, where'd that come from? Oh, 20 plus M20.
Was the negative equity contribution? No.
Oh, yeah. Yeah, can you take out that 1.8? There you go. Now check it out. 56 million. Okay. What's your total bond amount, Kent, that we got it now?
62.
Okay, that's our number, right? 62,
cash
and
flows.
we are 3 million short. Okay, that works. This is a science. So now we're 5 million short here. Issuer fees, blah, blah, blah. 1.8, so that's 3.8 short. Okay. And Kent, go back to your cash flows again for me. 117, 123, 128. We should be. Okay, go back to your budget for me. Add to your 62 million, add that $3 million that we're short. Make it 65.5. Oh, we went the wrong way.
Mm-hmm.
$56.5. There you go. $500,000. Okay. $1.18 million. Okay, one more time. Can you go to the top for me? Make it 50. Yeah, there you go. 58.5. Will that zero it out?
Almost.
640,000. Okay. So you could go to 58 million even.
Fair.
That's close enough. Well, you can go to 59 if you want, or 58.2, and that should zero it out. Okay. Get back 300,000 at closing, whatever. That's
Okay.
close enough for now. Now go back to your cash flows. Our DCR is good. Debt service coverage reserve is good. And at a 125 number, you could almost take your debt amount up some, but I wouldn't. Let's just leave it where it is because we're going to have some more moving around once we get blueprints and everything situated. But man, this is so now go back. Yeah, hit your support. Okay, we got all the rents. We know those are good. Go to your underwriting tab for me. We know we've got all of those expenses in good. And yep, go to your budget for me. We know that zeroed itself out with $300,000 over. And then yeah, take that number up. 300,000.
Take up the developer fee.
Or you could take it up, yeah, and see if that'll zero it out. And close
There you
enough. Okay. And then go to your summary and let's see what it looks like. Interest rate 6 3/4. Yep. Look at your NOI, 4,624,000. This thing's printing money. The land value as vacant, 17 million. As complete. Look at, oh, Kent, that came from the other number, right? That 129.
What?
24D, D24.
Oh yeah, that came from another number.
Okay, let's take that and put a formula there. And let's put the formula of, do a 6 cap times GNOI.
Well, your 6 cap would just be right here, right?
There it is. But that's at year 10. 96,850,000 in year 10. Let's do a 6 cap based on that 4 million over here and see what it does as complete. I don't know that it will I don't know if it'll give me what I'm looking for.
You're doing a 6 cap
106 times, what was that, D4? D9, yeah.
Whoops. Divide.
Yeah, my bad. 77 million at completion. As stabilized in 921, that's going to be very similar to, because that's a stabilized NOI, so it's going to probably mirror that 77 million.
Yeah.
But then when you look at your exit in 10 years,
This is what you care about.
that's your exit. If you sold this thing and retired your debt after 10 years, you walk away with 45 million bucks in the bank. After making 4 million a year NOI for the last 10 years. Well, you don't make 4 million. Can't go to your cash flows and what flows to the bottom line? $500,000 a year to the bottom. Oh shit, million, 2 million, 6 million, 9, 2, 1. So you're making a bunch of money every year. And then you sell it and you got 45 million at the end of 10. That's it, man. We done it. It took us an hour and 18 minutes. And see, I'm not concerned about this because we understand our construction costs. You know, we've got the same building design that we will use over and over again. We're in the process of pricing that building out for a project we're using in Anna, Texas that, I didn't even tell you about that one, but that one should be, I should be getting term sheets for it this week. And so once we price those out, then we'll have hard construction numbers to plug into here. And Ken, I think this is good enough. We could send to Ann for a high level look.
Love it. No, this works really, really well. I think this was a great exercise for you guys to go through and understand, like, how do we talk it over with one another, understand where we have rooms in the budget. You guys saw us play around with a developer fee. And again, this is, can't make this number up, $45 million. You can sell this property at assuming 6 cap, right? You can bump up the exit cap rate to whatever assumptions that you feel comfortable with. But I think we get a lot of questions about, you know, how do nonprofits make money? This is
like this. One more thing, can't go back to that developer fee. Now, in the event that we were $4 million short, or we were $2 million short, and these numbers didn't work, you can defer that developer fee. Because that's how we get paid, or the developer gets paid, or the owner gets paid. That number can be deferred and pulled from cash flow. And so it would be the first thing paid after debt service and expenses until it's paid out. So you can always get creative and move your numbers around. You saw, we moved every number around on this thing just to make it work. And those are based on numbers that we kind of know, and some of them are assumptions, but those assumptions are based on historical past. And this thing will flush itself out more and more as we get the blueprints and pricing down on the construction costs. Those attorneys' fees and things like that, placement agent fees, a lot of those are kind of standard for this size deal, maybe a little bit high, because I think a lot of those numbers may have come from our 400 unit deal, but I'd rather err on the side of being too high than being too low. And that's how we build these. And then we engage all of the third-party reports, the engineer, the architect. And the architect, really the only thing he does, if we did not already have that building designed, is he would design us a building and give that footprint of that building to the engineer, because when the engineer does the site plan, he takes that square of the survey and places the buildings the best way to utilize the land. We probably have to have a detention pond on site as well, parking in and out, multiple, you got one entrance, one exit. So they've got to configure all that to make it flow. And, but the first report we would order once we pass this along is going to be the market study to support everything that we've done here. That market study will be our Bible that says, yes, we can get these rents. Yes, this project is feasible, 256 units in this area. It'll tell us all the other apartments that are being built in that area with coming online within the next 2 years, and everything that's in that market that's been built ever. And so it compares all of those properties, all of the economics of that to tell us whether this thing is feasible to build or not. Based on the housing need in Arlington, Texas, based on the area median income, I can assure you that it's going to be a favorable market study. And then what we do from there is we get the architects done, get it priced out for our builder. Those are the two drivers, really. The construction cost is the biggest one, and everything else can just kind of flow seamlessly the way we made it flow through this Proforma.
Beautiful. This was fun.
Yeah.
Go ahead, Peggy.
We had a few questions and comments.
Oh, yeah, let's go
I
through them.
know that.
Questions, let's see, Wilson. Okay, Lamb, FYI, I'm trying to join from iPad because I can't see the screen from my phone. Sorry about that, man. But it's on my YouTube and it's live right now. So you can go to my YouTube, Alvin Hope Johnson, and you can watch it over. Imagine if this was in an opportunity zone. Well, Margaret, that does work for investors that are worried about income tax, but as a nonprofit.
Yeah, I said it and then I was like, wait, it's not even necessary. He doesn't
Right.
have to worry about that at all.
Right. But it's the same. Now, the difference, if this were a market rate deal, you'd have to have higher rents because, you know, we left out over $1 million in property taxes.
Mm-hmm.
So we would have to accommodate for that. And that would basically be done very easily by taking all the rents up to market rate, removing the rents on the 60s and removing the rents on the 80s and making them all market. That would allow this to flow seamlessly and probably have exactly the same numbers once we plug the taxes back in. The only difference is the equity portion would have to be raised. So based on a total capital stack, you may have to raise 30% of that amount in equity.
Okay.
You're not paying an interest rate to your lender for that amount, but you may be paying a little higher interest rate to your investors for their equity, right? But what would happen at the time this thing is built, it's worth 80 million because we don't have those lower rents in it. You've got a $50 million debt. You can refinance that in 3 or 4 years and pay your investors out.
Okay. Okay.
Daryl, how long does it take to start to finish? I think the entitlement process is about 6 months in most of these cities, and 6 to 8 months. Once we know that everything is good, we can start the architects. Like I said, we've already got these plans. If you like that kind of floor plan on that building, then we can kind of engage them about 3 or 4 months into that process after the site plan has been laid out to get the blueprints done. So typically within 12 months, you'd be ready for construction. And then on something this size, about 12 to 16 months. I'd probably say 16 to 18 months on 250 units. They've assured me they could do 200 units in 14 months. Or we don't have bad weather, you know, for shutting the site down for months at a time.
Continue with that engineered system that you were exploring before?
Yes, yes. And so what he asked, you know, we structured all of our deals to be built with structurally insulated panels. It's a little higher cost of construction. One of the things that we left out of this model, because they're built with those panels, these things should not have an electric bill over $40 a month, period. None of them. And so what we have done in other models is we have made this an all bills paid community. That's why we added all the appliances to control the cost of the electricity. And then we would charge the resident about $120 a month for the electricity that we know should not exceed $40 per month in those units based on the efficiency of the units. Trying this, we're doing it. So the deal we're doing in Princeton is going to be built out of the panels. We'll have we got 200 units built out of panels and 200 units being stick built. Daryl, we've had data that shows us what these units will do, but we'll have a real life case study here in a short time. So the next few deals that we're designing, we're not including that light bill because, boy, I sure hate to underwrite that deal and they don't perform the way they told me they did.
Will there be any issues coming up, like especially with all, you know, the economy, or you just, I know that you're working with low housing income and there's a need for that. Do you foresee any future problems possibly?
Not the way we're financing these. If we were contingent upon, now the bond market fluctuates as well, right? But typically when interest rates go up, the bond market is pretty stable because people love to buy these bonds at a higher rate. And then because they're tax exempt bonds, they don't pay any income tax on the money that they make from this mortgage. So when the interest rates go up in the regular market, these bond rates go up as well. That makes these things a lot more attractive for the guys buying the bonds because they're getting a higher coupon rate and they don't pay any income tax on their gains. So I think that, you know, for the next foreseeable 3-4 years, as these rates continue to climb, this is probably one of the best financing vehicles out there, especially for this type of housing.
So like those loans are people that are, those loans that are gonna come due on commercial, those loans are gonna hit the fan soon.
They are. They are.
Yeah.
Ali, man, I can't share this template, baby. This thing is millions of dollars. But you can send me your deal and we can build you one.
All right. Thank you.
Yes, sir. No problem. And we can do this with your deal, right? And walk with you. And then when you get ready to put your deal together, we'll show you how we can be a consultant for you. I'll just tell you real quick. So this particular deal, they own the land, so we won't use that. But let's just assume that those 13 acres were for sale. That 13 acres in Arlington would probably cost you $2 million. Once we get all the entitlements in place, not the full, you know, you saw on that engineer report, it's like 229,000. Well, that's all the way through the construction docs. Halfway through that point, we've got all the entitlements in place. So that's roughly $1 million for them. Was it? Yeah. No, roughly 100,000. It was 229. Halfway through that's roughly 100,000 for the engineers. We've got another cost for the architects that just call it 100,000. That could be 100,000 to walk all of this through the city with the engineer and make sure everything is platted. Once this thing is fully platted for 256 units, what we've done is we have turned this deal into roughly $10 million in value because it's entitled for 256 units and you can put a $30,000 or a $40,000 per unit value on that. So even if you did 256 times 30,000, we're at 7.6 million. Now you got a $2 million purchase price on the dirt. What we would do after this is ready to be entitled. You hadn't even paid for the land yet. We've tied it up with a contract that would be bought and paid for when the entitlements are approved. So now we have created $7 million in value. You got a $2 million purchase price. Then we go out and get a 50% LTV loan based on that $7.5 million value. You get about a $3.2, $3.5 million loan. Buy the land, you got $1.5 million left. I'd probably try to stretch the loan a little bit higher, closer to $4.5 million, so that we can get all the construction docs done, buy the land, get all the construction docs done from the architect, and still have some money left over to service that $4 million debt. So now we bought the land, we got all the entitlements in place, we got construction docs. You have turned that deal into $7.5 million in value. Once the blueprints are done, you could probably take that value up another couple of $1 million just based on the money spent. So now you got close to 10 million in value, and all you spent was 300,000 in cash out of pocket on the front end of this. Everything else was borrowed money. The borrowed money serviced the debt on that borrowed money. And now we take those construction docs and roll into this tax exempt bond deal. And you've got no more money out of pocket and this thing is fully funded. And that's how we can do that for you as a consultant. So you can partner with, oh, and we got a lady that'll finance 250 to 300,000 if you got a 680 credit score. So that makes this like, so now you can take 250 that you borrow, put 50 to the side to pay for the $200,000 loan, and you really just need about $50,000 to $60,000 on your own. And you can partner with 2 or 3 people to come up with that. And it's not paid all at front. You know, our fee is monthly. The engineers are paid as their work is completed. Same thing with the architects. So you could literally probably get engaged with this for about 50,000 to get started.
And Alvin and I, we want to work with people that can raise 50 grand, 100 grand. If you know you can get a $7 million deal, a $10 million deal. I think it says a lot about our clients is like, hey, if you've got a slam dunk, can you go out and do it? and put in the work, because just like Alvin and Peggy and we talked about earlier, the only way we'll get to 20,000 is by helping you, Allie, get your 200 units, helping you, Daryl, get 200 units, helping Margaret get 200 units. This is it. This is fun. This is why we want to do it together. We don't want to do it by ourselves. This, whatever cause you care most about, there's probably a nonprofit out there for it, whether it's people aging out of the foster system, women in domestic abuse. It doesn't matter what, veterans. It doesn't matter what cause or population you care about. You can make a true impact. And that's what working with Alvin and Peggy and myself at Springboard RA can do for you and the population you care most about.
We call it doing good while doing good.
And how can we contact you guys, or is there like a email, Instagram?
Yeah, Ali, yeah, my email is alvin@372hope.org. I'll put it in the chat. All of our emails are, yeah, that's it. You can shoot me. You can put yours in there as well. Peggy, you can put yours in there as well. All of our emails are gonna change probably this week, or we'll still have these, but it'll be alvin@springboardra.com, Kent@springboardra.com, Peggy@springboardra.com.
So
Did you do any deals with anybody out of Apex?
Say that again, Dal.
Did you do any deals with anybody out of Apex?
Stuma's the only one that invested with us out of Apex. And really over the last year, we have set back. We're still working on that deal in Princeton that everybody has invested in. We've got a really great way to get everybody their money out of that thing before it's even built. So I think we're gonna walk down that path next week, and they'll get their 18 to 21% expected return in 2 years. And all we did was buy the land, get it re-entitled for the 400 units. It was already entitled, but we changed the building footprints and everything, changed all of that. We paid $7.5 million for the dirt. Today it's worth 15 million. And I think I can sell it and get everybody out and get them their money, and we can go on and just keep doing some deals. So that's what we're looking at doing now with that one. But just by creating value, just like we just explained, we took that one deal that we paid $7.5 million for that was already entitled. We put the ponds on it. We put all the underground water. I think we spent close to $2 million on it. And that $2 million has elevated the value to about 15 million.
That was your zone cap, 100, 200?
400.
400, that's not bad.
Yeah. Well, y'all, man, I appreciate y'all's
Thank you, Alvin.
this Monday out with us.
Yeah, it says a lot about this group that's working on Labor Day.
I know, right?
When the rest of the world is sleeping and hanging out at barbecues. I think it says
Drinking
a lot about
beers
this group
and-
that's hanging out with
Bro,
us.
I'm drunk on boats instead.
What'd you say, Darryl?
Bro, I'm drunk on boats instead.
Right.
I made 100 grand this morning on real estate transactions, with residential real estate, so I was out of the hospital today.
Man, Darryl, buy you a ticket from Detroit and come down here to Houston. Let's go get that deal done.
Yeah, we'll do that. You know what? We'll do that. Hey, listen, we'll do that in October. I'll come down from the 1st to the 15th, because it's gonna be my birthday, and I got some friends to see down there.
Perfect.
Cool. Well, thanks for the time, you guys, today.
Hey, no, my pleasure, man. Thank y'all for tapping in with us.
No problem. Alvin,
Hey,
I'm
Angela,
thinking
good to
since
see you.
you went through Alvin, since you went through that statement of work earlier about all the contracts, about all the different reports, I think it'll be a great idea for you and I to get on a podcast. We'll talk through like, hey, what is an environmental report at? What is a topography report? Like just quickly go round robin.
And make
What
some
is it?
shorts.
Yeah.
Let's do it
What
tomorrow.
is it? Yeah, let's do that. What is it? What are the problems, and any sort of stories of issues that you've encountered or the architects or engineers have encountered, and we just kind of spitball it so people can understand what they can look out for. I think that'll give everybody here massive amounts of value.
Great. Do you have a copy? Yeah, you got a copy of that agreement.
I do.
Okay.
So we'll just go down that line tomorrow.
That'll work.
And everybody,
ahead.
don't forget to get your book, The New Look of Affordable Housing by
Yes.
Alvin Hope Johnson.
Oh,
Got to get
But
that
yeah,
book.
that-
And we're not just, tooting our own horns. Like we've met with plenty of other folks that manage a lot of affordable housing developments. And when we first showed them our sketch, one of our guests on our podcast was George Spolsky. He does 5 to 7 major projects a year as a consultant. He's like, wow. When he first saw that drawing, he said, wow, this is affordable. And I think that's something that we're all really, really proud of.
Hey, Alvin,
Yes.
just so you know, I did talk to the regional vet bash office out here in the Houston area. Now, when I talked to the young woman I talked to, she talked about the fact that they only had currently about 25 more bash vouchers. But then I've been reading up on what Houston did back in 2012 and through 2015. And the developer out here had teamed up with the Houston organization who had committed itself to finding housing for veterans. And some kind of way they were identifying homeless veterans and getting them their vet bash in 24 hours. So I'm trying to figure out what it is that they had set up in order to make that a reality at that time. And figure out who I need to talk to about that. Because I see it was the Travis Street Plaza that teamed up with an organization out here. So I'm going to try to get into contact with the organization. It was called the Houston/Harris County Continuum of Care. And the federal plan that they were using to implement this was called The Way Home. So I'm just trying to figure out how they made it work to see if it can be made to work in the Hardin County, Golden, Jefferson County area.
Yes. Yep.
But so it's
and doing it in the Hardin, Jefferson County area may be easier than Harris County.
yes, that was another thing. I know that veteran housing is still very much an issue in that area versus in Harris County, where they've been having initiatives since 2012, 2015. So I know Harris County is behind the ball on that, and they definitely have federal dollars to deposit into the program. So that's why I was like, that's where we're from, and they need the assistance. So right now it's just getting the right people together to make sure that the ones who know how to make it happen, I have them on speed dial, right?
And so y'all, me and Margaret we had a call, 2 weeks ago, 3 weeks ago?
Yeah.
Wanting to do a deal down in South Texas. We're both from Beaumont. So I'm just glad were you in Clubhouse this morning?
Yes, I was.
Okay. Yeah. We're good. But as Kent, we talked about the underwriting and having those vouchers at the full market rate. So now you got the full picture of how that works by watching the Proforma. Yeah, that's good.
And Margaret, in every city or county, usually there's like a rapid rehousing agency. Sometimes it might be called like the CMA in Detroit. I've heard every city has their own. It's just a mechanism for how do you fast track people to get their vouchers faster. It could be just people that are, you mentioned homeless vets, but there could be folks that are homeless, they're staying at a shelter, and because they're staying in a shelter, they might qualify for a fast track on the Section 8 voucher list, not just the veteran voucher. So you can look into that to see if anything like that exists for Houston specifically.
Definitely. Thanks. Yeah, I guess disabled, currently already homeless, and then the vets.
Yeah, exactly.
People in California.
Say it again.
California.
There's not enough resources out there for that.
It is a nightmare out there. That's the worst place to play.
Me and Kent was on a call with a group in California 2 weeks ago, and the guy told us with the housing authority that landlords are giving their vouchers back because they don't pay enough. Because the rent has gone so high. Like, you can keep that junk, man. Say that again.
I went to California in December of last year, and it was a total nightmare when I was living there.
Daryl, I don't know if it's your internet or mine. Is it?
Yeah,
Daryl?
I can't really hear you, Daryl. Could you type in that question? For some reason, it's coming off a little blurry. While you're typing that in, Alvin, Solano County, I just read the news report. That's where a couple of Silicon billionaires are buying up all the land, trying to create a new city in the Solano County area.
Really? With the guys that we talked to in Solano County?
Same county, small world.
It is a small world. Well, that's going to make that affordable housing even more attractive there, isn't it?
Oh, they definitely need affordable housing if now they got all this bad press saying that they're just trying to build their own utopia over there.
Yeah.
I was thinking, Alvin, when I left California in December of last year, it was a nightmare. It was a nightmare for housing there,
Yeah.
and everything was insane. And you know, they kicked all the people out of the crazy home in California, out of the hospitals, and then there's just nowhere for anybody to live. Like LA looks like a freaking war zone, like the end of the world, you know?
Kent, you live in San Diego. What's downtown San Diego look like now?
It's a mess too down there.
I mean, I heard it's not as bad as San Francisco, where
Okay.
you know, I have cousins that live in San Francisco, and Fisherman's Wharf, Union Square, you very popular touristy areas. She literally told me don't go there anymore.
Wow.
She's like, don't go there. You bring a car there, it's gonna get broken in. It's really, really tough times for a lot of people. For me, when I went to visit the San Diego County Housing Authority, told me the wait list. This was just less than a year ago. They told me the wait list was 12 to 15 years. So 12 to 15 years. If you're just imagine you're a single mom, you're trying to get out of a bad area and you get towed 12 to 15 years, it's almost forget about it.
Forget about it.
Yeah, for us, that's just why we do this. It's like we're doing everything we can to get more supply to the market because there's an incredible amount of demand there. And I think, again, that's another benefit of working with Peggy, Alvin, and myself. It's because we have spent so much time and energy trying to find investors for affordable housing. It was not easy finding 100% of the capital set. Now, we can't guarantee that they will invest, but I think that's why you have a benefit in hiring us as your consultant, so that one, we can test the waters, see whether or not it meets the criteria of our investors, because there's a tremendous amount of risk associated with development, and you want to mitigate that risk in every single way as possible, but you can never cancel it all out. But it helps to have and know where your investors' mindset is and whether or not they believe in that area. So
Right.
we gave some criteria earlier about AMI over 80 grand, MSA population over 250,000 people, but you never know. They might say, hey, this is too far from a downtown area, or they say, hey, maybe this area might work. You don't
You're not
know
coming to
unless you
Detroit
ask.
then.
What'd you say about Detroit?
You're not coming to Detroit then.
Well, Daryl, it depends, because Detroit needs this really, really bad. And Detroit may have a situation where they would allocate 250 housing vouchers or 100 housing vouchers. So if they would do that, man, this thing, that's money in the bank.
Yeah, I believe Detroit or the areas in Michigan has one of the highest per capita spend for affordable housing. Out of
Daryl,
the
do you
entire
live in
United
Birmingham?
States.
No, but it's not far from me. It's probably 40 minutes away. A couple of the Apex guys come to Birmingham a lot.
Okay.
It's like 40 minutes away, but Birmingham is the highest, besides Traverse City, is one of the highest income areas in Michigan.
I got a couple of friends live up there.
Oh yeah, they're ballers for sure.
Yeah, they are.
Yeah.
And you have areas with high median income right there, Daryl, right? Like Royal Oak, Ferndale areas.
Northville, Novi, Troy, Birmingham, usually where all the foreigners come in, the Indians, mainly the Indians, they're all doctors, lawyers, attorneys, engineers. So yeah, we have a lot of that. In Detroit sits like right center of those, like south and center, and all the rich areas sit above of it. About Detroit's probably 10, 15 miles outside of those areas. But we don't have traffic problems, so it's like quick to get there. It's not like Texas and in California, But if there's some of those programs available in Michigan, they're definitely worth looking at, and seeing what's out there. They're going to be building. Yeah, all I got to do is make some phone calls, and they're building a new bridge to Canada. They have one, and they have a tunnel, and then they're building a new set of that. And they basically demoed 5 or 8 square miles. They bought all the homes and just demoed it. So once that bridge gets built, they may be entertaining housing back down there again.
A lot of times when they do that, you take those homes for eminent domain, they promise the residents that they will replace that at some point.
Right. Yeah.
Well, guys, I got to run, man. I'm going
Me
to sit
too.
myself in the sauna for 5 hours.
Well, thanks, Alvin. I loved it. Thanks, everybody. Great meeting you, Peggy and Kent.
Thank you.
And I'll see you in October for sure, Alvin, but we'll connect soon.
Sounds good, man. Appreciate you.
All right, brother.
All right.
Have a great day, everybody. Bye.
Margaret, thanks for tapping in. Hey, Larry, Eugene, Lamb, good to see y'all.
Hey, Alvin, don't forget to download the recording so I can use it.
I will. It'll probably take an hour to download, and then I'll send
That's
it to you.
perfectly fine. Yeah.
Okay.
Don't delete it.
I
All
will.
right, bye.
Bye,
Bye.
guys.